Hey there, welcome back. We're diving into startup funding today. Seed funding, to be exact. We've got excerpts from a guide on seed fundraising, plus some cool stuff about Y Combinator. Y Combinator, the accelerator behind Reddit and DoorDash. But why raise money at all? Can't you just build a business the old-fashioned way?
It's about what makes high-growth startups different. Like imagine taking a jumbo jet off the ground. You need a really long runway, right? Well, that runway is seed funding. It's the fuel. Bootstrapping is possible, but it's like flying that jumbo jet with a tiny propeller engine. It can be done, but not the usual route.
Okay, that makes sense. So when are you ready to hit the tarmac and start asking for that funding?
Our guide says compelling story. It's not just an idea. It's articulating why it's a game changer.
So you're saying it's not enough to just talk the talk. You need to walk the walk.
Exactly. The best way is data. The guide mentions a 10% week-over-week growth rate, like a giant neon sign that says, hey, investors, look. That kind of traction proves demand.
Okay, you've got your compelling story and some traction. How much money should you ask for?
Ideally, raise enough to reach profitability. Then you're not constantly fundraising. But that's not always realistic. A good rule, aim for 12 to 18 months of runway.
12 to 18 months, got it. But how do you translate that into dollars?
The guide breaks down your burn rate. They use the example of an engineer, about $15,000 per month, salary, benefits, everything. So if you're planning on, say, 3 engineers for the next year and a half.
You're saying it's about having a clear budget, no shooting in the dark. The guide also dives into funding options, convertible debt, safe fees, equity. Where do we even begin?
Let's break those down. Convertible debt first. It's like a loan, but it converts to equity, usually during a future funding round.
An IOU that turns into a piece of the company?
Exactly.
Yeah.
And there are details. The interest rate, the maturity date, the cap and discount. They basically give early investors a better deal.
A thank you for the early gamble.
Yeah. And the terms are negotiable. Now, safe fees, they're really popular, especially with Y Combinator.
What makes them so special?
SAFE stands for Simple Agreement for Future Equity. And it's simple, like convertible debt, but simpler. No interest rate or maturity date. Faster and less complicated. All about speed and simplicity, especially early on. And then there's equity. Straightforward concept, but can be a pain to execute.
Okay, equity. Sounds like selling a piece of your company.
Yeah, you're selling actual shares. That means putting a valuation on your company and then issuing new stock.
How do you even put a price tag on something so new? It's like predicting the stock market.
You're not alone. Valuation is tricky, especially early on. No perfect formula.
So how do you make sure you're not undervaluing your company or overvaluing it?
It's a balancing act. It's about the sweet spot.
Mm-hmm.
A valuation that's fair allows you to raise enough capital.
Yeah.
It doesn't mean giving away too much of your company.
A win-win for you and the investors.
Exactly. And understand the players. Angel investors and venture capitalists, remember the jumbo jet analogy? Venture capitalists are like those big airlines.
The heavy hitters.
Exactly. They manage huge funds, hundreds of millions, even billions. They're looking for home runs. Companies with huge potential. Angel investors are different, more like independent pilots.
They're putting their own skin in the game.
You got it. They use their own money. They invest earlier, sometimes even before launch.
So there's more personal risk.
Yeah. They have a more flexible approach. They might go with their gut.
So it's not just about the numbers.
Absolutely. They look for companies and founders they connect with. They might love the industry or the problem the company solves.
It's like the Wild West of investing.
You could say that, but don't forget networking. Crucial no matter what.
Right. The guide mentions warm introductions. What does that even mean?
Warm introductions are everything. Imagine trying to get into an exclusive party. Easier if you know someone, right? Same with investors.
Leveraging your network.
Exactly. Don't be afraid to tap into that.
And if that's not working out?
Demo days. Your chance to pitch to a room full of investors.
American Idol for startups.
Pretty much.
Okay, so you've got that meeting. What's next?
This is it. You've got your foot in the door. Our guide talks about treating investor meetings like conversations, not presentations.
So connecting on a human level.
Exactly. Investors are people too. They want to see your passion, that you have a vision, and that they can work with you.
Being authentic.
You got it. Don't be afraid to ask them questions. Investors love to see you're curious. It shows you value their expertise.
It's like dating, but for funding.
That's it. One last bit of wisdom from the guide. It asks, fundraising is like climbing a mountain, but what happens at the summit?
It's easy to get caught up in the funding, But that's not the finish line.
Exactly. You've got the jumbo jet off the ground, but now you have to navigate.
What should founders prepare for after seed funding?
Well, you have to deliver. Build the team, hit those milestones, keep growing.
And prove the investors right.
Yeah, it's a lot to manage. You're managing expectations, navigating the ups and downs.
And thinking about the next round of funding.
The climb never ends.
Not for the ambitious, but that's what makes it exciting.
Well, that's a wrap on today's deep dive. Thank you for joining us.
It was great being here.
And to our listener, keep exploring, keep asking questions, and keep building. Until next time.